Did you know that over the past 100 years, the US dollar has lost more than 95% of its value due to inflation? In simpler terms, what $1 could buy in 1923 now costs you around $20. Shocking, right? And this isn't just some far-off historical fact, this is happening to your money right now. Many people think their savings are safe in a bank, but inflation and hidden risks are silently eating away at your wealth. The average person isn't even aware that their money is losing value every single year. And it's not just inflation, currency devaluation, market volatility, and bad investment choices are all playing a part. But here's the good news, there's a way to fight back. In this video, I'll reveal how to protect your money, invest wisely, and make it grow, even in times when everything seems to be working against you. You'll learn why quick gains can actually hurt your finances, how to invest using the margin of safety, and why dividends might be the key to your long-term success. Stick around, and I'll show you why time is your best friend when it comes to wealth building, and how you can take advantage of it to build the future you deserve. Chapter 1. The Silent Erosion. How inflation is stealing your wealth. Inflation is often called the silent killer of your wealth. It quietly erodes the value of money over time, making things more expensive without you even realizing it. In 2023, inflation in the US reached 6.5%, which means that if you didn't invest your money, it lost 6.5% of its purchasing power in just 1 year. Imagine what inflation does to your savings over decades. For example, let's say you've got $100,000 saved up in a bank account earning no interest. After 10 years of 2% inflation, that money will be worth only $81,700 in today's dollars. This is why simply holding cash isn't the smartest strategy for long-term wealth growth. The solution? Invest in assets that have a chance to outpace inflation, like stocks, real estate, or gold. Warren Buffett often talks about how inflation pushes the cost of goods and services higher, which makes everything more expensive. But his strategy is to invest in businesses that have a moat, a competitive advantage, that helps them survive rising prices. By investing in companies that can raise their prices over time, you protect yourself from inflation's effects. A good example of this is Coca-Cola. For decades, Coca-Cola has increased its prices, making its stock a solid long-term investment. The company has consistently outpaced inflation, providing steady returns to its investors. If you had invested in Coca-Cola in the 1980s, your money would have grown significantly faster than it would in a savings account. To protect yourself from inflation, it's important to understand that not all investments are created equal. Bonds, for example, often fail to outpace inflation, especially during times of rising prices. Real estate, on the other hand, tends to rise in value alongside inflation. Stocks, particularly dividend-paying stocks, have historically been one of the best ways to combat inflation. Investing in a diverse mix of assets helps spread the risk. Diversification isn't just about reducing the chance of a loss, it's about positioning your portfolio to grow while inflation is working against your cash. For instance, if you had a portfolio that was 60% in stocks and 40% in bonds, historically, this would have outpaced inflation by a significant margin over time. It's also important to pay attention to interest rates. When the Federal Reserve raises interest rates, it's usually a sign that inflation is rising. However, higher interest rates can also make borrowing more expensive. This is where savvy value investors come in. By being aware of these changes and adjusting their portfolios accordingly, they can make smarter, inflation-proof decisions. Remember that inflation doesn't just affect the stock market. It impacts the cost of everyday things, like groceries, gas, and even rent. This means your purchasing power is getting weaker every year unless you make your money work harder through smart investing. Chapter 2. The Hidden Killer. Currency devaluation and its impact on your savings. Currency devaluation is another major factor that's eating away at your wealth. It happens when a country's central bank prints more money, which makes the value of the currency drop. This is something we've seen in various countries throughout history, like in Venezuela or Zimbabwe, where hyperinflation wiped out savings. In the US, currency devaluation is a more subtle problem. Since the US dollar is the world's reserve currency, it doesn't suffer as much from rapid devaluation. But even so, over the last century, the dollar has lost about 95% of its value due to inflation and currency printing. This is why holding large amounts of cash isn't an effective long-term strategy. A classic example of currency devaluation is the Federal Reserve's money printing policies during the COVID-19 pandemic. The government pumped trillions of dollars into the economy, which led to an increase in inflation and a decrease in the dollar's purchasing power. This is why it's crucial to invest in assets that protect against devaluation. Gold is often considered a safe haven in times of currency devaluation. It's a store of value that has survived through centuries of financial crises. For example, in 1971, President Nixon took the U.S. off the gold standard, and since then, the price of gold has increased dramatically, reflecting the loss of value in fiat currencies like the dollar. Stocks, especially in companies with strong international operations, can also be a hedge against currency risk. For instance, companies like Microsoft and Apple earn significant revenue from outside the U.S. This means that if the dollar weakens, their overseas earnings become more valuable, helping offset any domestic losses. Diversifying your investments across global markets is another way to protect yourself from currency devaluation. By holding assets in different currencies and economies, you reduce your risk of losing money if one currency drops in value. It's important to recognize that currency devaluation can happen gradually, over years, but it can also happen quickly. The value of the US dollar, for example, has fluctuated significantly since 2008, with periods of strength followed by sharp declines. This is why you need a strategy to protect your wealth, especially when it comes to long-term savings. One strategy to hedge against currency risk is investing in foreign assets or funds. These investments are tied to currencies other than the dollar, which means you're not entirely dependent on the US dollar for your returns. If you're worried about the dollar losing more value, another option is to consider cryptocurrency. While volatile, some investors see Bitcoin as a digital store of value, similar to gold. Just remember that like all investments, cryptocurrencies come with risks, and you should always do your research before diving in. Chapter 3. Investing with a margin of safety, your shield against financial decline. The concept of a margin of safety is at the heart of value investing. It's the idea that you should always buy an asset at a price lower than its intrinsic value. This gives you a cushion, so if things go wrong, you're less likely to lose money. Benjamin Graham, the father of value investing and mentor to Warren Buffett, famously said, "The essence of investment management is the management of risks, not the management of returns." Graham taught that the key to long-term success is buying businesses that are undervalued, ensuring that you're investing with a built-in safety net. Let's say you're looking at a stock. If the stock is worth $100 per share, but you can buy it for $60 because the market has temporarily undervalued it, you've created a margin of safety. This means that even if things don't go as planned, you still have room for the stock to drop without losing too much. This approach is important because it helps you avoid speculative investments that can lead to big losses. It's about focusing on long-term value rather than trying to make quick profits. Companies with strong fundamentals, solid earnings, and undervalued stock prices are much more likely to weather economic downturns. One of the best ways to assess the margin of safety is to look at a company's price-to-earnings (P/E) ratio. A low P/E ratio compared to industry peers can be an indication that a stock is undervalued. However, don't rely on P/E alone. It's important to evaluate the company's earnings history, debt levels, and growth prospects as well. Graham's margin of safety principle also applies to other investments, like real estate. If you buy a property at a significant discount to its market value, you're giving yourself a cushion in case the market doesn't perform as expected. This is especially true when purchasing rental properties that generate passive income. Remember, the goal isn't to take unnecessary risks. It's about making informed decisions based on solid research. The more you understand the true value of an asset, the better equipped you'll be to make smart investment choices. This strategy is particularly important during economic downturns. In a market downturn, many stocks and assets are temporarily undervalued, creating opportunities for value investors to swoop in and buy assets at a discount. During these times, it's crucial to stick to your margin of safety strategy and avoid getting swept up in panic selling. If you're new to value investing, the margin of safety concept can be a game changer. It allows you to take a more cautious approach while still finding opportunities to grow your wealth. As Buffett says, the stock market is a device for transferring money from the impatient to the patient. Investing with a margin of safety requires patience, but it's a strategy that can lead to long-term success. Make sure to hit that subscribe button if you want to learn more about building a strong financial foundation and growing your wealth over time. Chapter 4. The Mirage of Quick Gains. Why chasing hot trends will cost you. Chasing hot trends in the market can feel exciting, but it's often a dangerous game. Whether it's the latest tech stock, a cryptocurrency boom, or the next viral investment, these trends often don't stand the test of time. While many investors get rich quickly during these periods, the majority end up losing everything once the bubble bursts. Take the dot-com bubble of the late 1990s. Many investors rushed to buy tech stocks, hoping to cash in on the next big thing. In the end, more than $5 trillion was wiped out as stocks crashed. Even the biggest companies like Pets.com, which was once valued at $1.2 billion, went bankrupt. This serves as a clear reminder that trends can be fleeting and risky. Rather than following the crowd, value investing focuses on finding strong, stable companies that are undervalued by the market. Warren Buffett says it best: be fearful when others are greedy, and be greedy when others are fearful. This means that when everyone is piling into a hot trend, it's often a sign that the prices are inflated, and a pullback is imminent. In contrast, value investing is about patience. Instead of trying to jump on the next big trend, value investors buy stocks that are selling for less than their true value. These companies may not be the flashiest, but they are usually more stable and reliable for long-term growth. Remember the rise of Bitcoin and other cryptocurrencies in 2017. At its peak, Bitcoin was worth nearly $20,000, but by the following year, it had plunged to less than $4,000. If you had bought into the hype without understanding the risks, you could have lost a significant portion of your investment. Instead of betting on fleeting trends, consider investing in established businesses with strong fundamentals. This could be companies with a proven track record, healthy balance sheets, and competitive advantages in their industries. These are the types of investments that will withstand the test of time and deliver steady returns. Chapter 5. Dividends over speculation. How consistent income beats market volatility. Dividends are one of the best ways to protect your investment from market volatility. They offer a steady stream of income, regardless of how the market is performing. Dividends provide a cushion during market downturns, making them a popular strategy among value investors who want to minimize risk while still growing their wealth. Companies that pay regular dividends are often well established, with a stable business model and predictable cash flows. These companies aren't trying to make a quick profit, they're focused on long-term growth and shareholder value. Investing in these types of companies can provide you with both capital appreciation and consistent income. Warren Buffett is a huge fan of dividend-paying stocks. His Berkshire Hathaway portfolio includes companies like Coca-Cola, American Express, and McDonald's, all of which pay healthy dividends. In fact, dividend-paying stocks have historically outperformed non-dividend stocks in the long run. According to a study by J.P. Morgan, dividends have accounted for over 40% of the total return of the S&P 500 since 1930. What makes dividends so attractive is their compounding effect. When you reinvest your dividends, your investment grows exponentially over time. This strategy is known as dividend reinvestment, and it's one of the most powerful tools for long-term wealth building. A $10,000 investment in a dividend-paying stock that yields 3% annually could turn into more than $40,000 in 20 years if dividends are reinvested. Chapter 6. The Power of Patience. Compounding and why time is your best friend. Compounding is the most powerful tool in value investing. Albert Einstein famously called it the eighth wonder of the world, and for good reason. When you reinvest your returns, your money grows exponentially, leading to more significant gains over time. The key to harnessing the power of compounding is patience. Compounding doesn't happen overnight. In fact, the real magic of compounding happens over long periods. If you invest $1,000 at an average return of 7% per year, after 10 years, it will grow to about $1,967. But after 30 years, it will grow to $7,612. The longer you leave your money to grow, the more powerful compounding becomes. Warren Buffett's wealth is a prime example of the power of compounding. He has often said that the secret to his success is simple. The most important quality for an investor is temperament, not intellect. Buffett's strategy is to buy great companies and hold them for the long term, letting the power of compounding work its magic. This is why value investing is so effective. When you invest in undervalued companies, you're essentially buying an asset that will appreciate over time. Instead of trying to make quick trades, you hold onto your investments, allowing them to grow steadily and consistently. Don't forget to subscribe if you want to learn more about creating wealth over time with smart, patient investing strategies.